So my dear friends, we are doing the question and answer on transfer pricing provisions. The next question, mark this question little important because so many adjustments are involved. Anush Motors Limited, an Indian company, declared income of 300 crores. Now the whole data you have to convert into crores. Please understand, they will give data in rupees and lakhs. Do not get confused. You have to convert the whole data in crores. Computed in accordance with chapter 4D, that is PGBP provisions. 4D means PGBP provisions, normal PGBP provisions. But before making any adjustment in respect of the following transactions for the year ended 31st March 2021, technically before making any TP adjustment, this is their original profit after applying all the allowances and disallowances which are given in income tax law PGBP chapter. So the transaction you have to observe very clearly. 10,000 cars are sold to Rida Limited, US company. Please understand, 10,000 cars are sold to Rida Limited, US company, which holds 30% of the shares in Anush Motors Limited at a price less by USD 200 each car than the price charged for Singato Limited. Maybe it is an unrelated party. Okay. Now, because they are having equity more than 26%, they are associate enterprises, and Rida Limited is a US based company, therefore this is an international transaction and it should have happened at arm's length price. But when India sells this particular car, cars are sold, please understand, they are selling 200 less. That means behind every car India is losing 200 US dollar, isn't it? That much adjustment we are going to make and that much amount we are going to add back to the income which is offered to us. So 10,000 cars into $200, the price will come into dollar, but we want the amount in rupees, therefore we have to convert it into Indian currency. Please understand. But when you multiply 10,000 into 200 into the foreign exchange rate, that amount will come into rupees. Please convert that particular amount into crores because we are going to write the whole data in crores. You cannot write data in rupees. 300 crore will be a very big number. So we have to convert all the data in crores. Remember that. That's a mathematical mistake that we people usually do. So here we are going to add 200 rupees per car, multiply by 10,000 car, multiply by foreign exchange rate. Royalty of USD 1 crore 20 lakh. Now here 1 crore 20 lakh, look at the royalty amount, such a huge royalty was paid to Kyoto Limited, a US based company. Again, India is making royalty payment to some K Limited or Kyoto Limited for use of technical know-how in a manufacturing car. However, Kyoto Limited had provided the same know-how to another Indian company at USD 90 lakh. So please understand. So this is a foreign based company, USA based company. Whenever we are making payment of royalty, we are making 120, 1 crore 20 lakhs. This much amount of penalty we are going to make 1 crore 20 lakh US dollars. Okay, such a huge penalty, such a huge royalty we are paying. But when we are paying to unrelated party, some unrelated, when they are giving the particular technology, they are giving the technology in India, and when unrelated party is making payment, they are only making payment of 90 lakh dollars. So here the payment is 120 lakh dollars, here the payment is 90 lakh dollars. Don't you think here India is losing almost 30 lakh dollars? And answer is yes, because this is an associate enterprise. You are making more payment to the associate enterprise. Sir, how do you come to know that this company is associate enterprise? Look at the next data. Kyoto Limited is the sole owner of the technology used by the Anush Motors Limited in a manufacturing process. So Anush is 100% dependent on the technology. Without Kyoto Limited technology, they cannot produce the cars. So whenever the technological dependency is shown, they become an associate enterprises, because obviously this foreign entity Kyoto Limited can influence the Anush Limited. Loan. Now we have taken the loan of euro 1000 crore carrying on the interest at the rate of 10% per annum. So this is the principal amount per annum advanced by Dorf Limited, a German company. So this is not a USA based company, this is a German company, was outstanding as on 31st March 2021. The total book value of the asset of the Anush Motors on the date was 90,000 crore rupees. Please understand. Now here it is in euro 1000. Please don't compare 1000 divided by 90. No. This is the wrong comparison. This is in euro and Please understand, this is in euro and this is in rupees. You cannot compare rupee. You cannot say, oh, India is having 90,000 crore book value of asset. This is just a 1,000 crore loan. This euro you have to convert into rupees, and you know that then it will become a huge amount. When you convert this euro into rupees, okay, look at this. The said German company had advanced the loan of similar amount to another Indian company at 9% per annum. So they are giving us 1% extra. That 1% extra, whatever India is making payment to German company, obviously that extra 1% we have to add back as a, please understand, that extra 1% we have to add back as a transfer pricing adjustment. The total interest paid for the year was euro 100 crore. So 100 crore we have paid. On 100 crore, extra 1% we have given. That much amount we have to add back to our profit. That is excess expenses shown by the Indian entity. So arm's length price is 9%, but we are showing it as a 10%. We have to disallow 1%. This is how you can understand. Explain in brief the provisions of the act affecting all this transaction and compute the income of the company chargeable to tax, keeping in the mind the value of 1 USD and 1 euro was 63 and 84 respectively. So for euro, you have to make this 84. When you multiply 84 with 1000, it becomes 84,000. 84,000 out of, my dear friends, 84,000 out of 90,000, that means more than 50% of the book value. Please understand, more than 50% of the book value of loan is given by one entity, and therefore Indian Ayush Limited and this German Dorf Limited are the associate enterprises according to section 92A. Any income arising from international transaction where two or more associate enterprises enter into mutual agreement or arrangement shall be computed having regard to the arm's length price as per the provisions of chapter 10 of the act. Section 92A defines associate enterprises, and subsection 2 of the section speak situation where two enterprises shall be deemed to be associate enterprises. By applying the clauses, you don't have to remember the clauses. It is clear that Anush Limited is associate enterprises with Rida Limited. Why, sir? This is the first company. Because the company holds shares, it was holding 30%, no? So it is holding more than 26% of the voting power of Anush Limited. Quo Limited, why? Because since the company is the sole owner of the technology used by Anush Motors Limited for manufacturing process. Dorf Limited, because it is holding more than 51% of the book value of the debt. You know, more than the debt is more than 50% value of the total asset of the Anush Limited in India. The transaction entered into by Anush Limited with a different companies are therefore has to be adjusted, and it should be worked out as follows. Income of the Anush Limited given in the crores was 300. Difference on account of adjustment of the international transaction that you have to see. Difference price of the car, 200 each car we were paying more. Okay, so please understand. So 200 each car for 10,000 car into 63. So and then we have to convert it into crores, 12.60 crore. Then difference for excess payment of the royalty. How much excess payment of the royalty was made? 30 crore. Please understand, 30 lakh rupees. 30 lakh into 63. 30 lakh into 63 will become Indian rupees, and that Indian rupees is 18.9 crore. Difference for the excess interest paid on a loan, euro. Please understand. So how much excess interest we have paid? 84 into 1000 into 1 divided by 100 into 1 divided by 100. This is 1% on 1000 crore euro loan, and this is 84. So 840 crores we have paid extra. Please understand. So this is the total amount of income that will happen after TP adjustment. So if assessee is agreed, he can go and put an appeal, or he can go for DRP. Okay. The difference of the excess payment of royalty has been added back, presuming that the manufacturing of the car of Anush Limited is wholly dependent on the use of technical know-how owned by it. And this is second assumption, that Anush Limited does not having advanced pricing arrangement, and it does not opted for safe harbor rules. Next question. XE Limited is an Indian company in which Jillal Inc., a US based company, who has 28% of the shareholding and voting power. Following transactions were affected between these two companies. So please understand, they are associate enterprises, and because this is located in US, there will be an international transaction. XE Limited sold 1 lakh pieces of t-shirts at USD 2 per t-shirt to Zilla Inc. So India is making sale, and India is making sale at $2 to the associate enterprises. The identical, exactly same t-shirt were sold to the unrelated party, namely Kennedy Inc. at USD 3 per t-shirt. So whenever you are making payment, making sale to unrelated party, whenever you are making sale to unrelated party, my dear friend, you are selling at the $3, meaning thereby for each t-shirt we are losing $1 as a revenue, and that much amount we will add back when we do the TP adjustment. XC Limited borrowed USD 2 lakh from a foreign lender based on the guarantee of Zilla Inc. For this, XC Limited paid USD 10,000 as a guarantee fee to Zilla Inc. To an unrelated party the same amount of loan, Zilla Inc. collected 7,000 as a guarantee fee. So here you can see they are making more expenses. First of all, they have reduced the revenue. Now India is booking more expenses in terms of guarantee fee. The we have debited 10,000. We have debited USD 10,000, $10,000, whereas the arm's length price should have become 7,000. That means extra 3,000 we have paid. Extra $3,000 we have paid. India has paid, and that much amount of expenses should be disallowed as a payment to the related party on account of TP adjustment. XC Limited paid USD 15,000 to the Zilla Inc. for getting the various potential customers details to improve its business. So this is for database. Zilla Inc. has provided the same services to the unrelated party at 10,000. So here also excess $5,000 we have paid to our related party. In short, in all these three transactions, in first transaction we have reduced the revenue, and next two transactions we have increased the expenses of India. The net effect is we are actually doing base erosion. We are doing the base erosion and profit shifting from India. That's a main part of the discussion that you should understand. Assume the rate of exchange of 1 USD is equal to 64. XC Limited is located in special economic zone, that is manufacturing company, and its income before transfer pricing adjustment for the year was 1,200 lakhs. Okay, now here data can be in lakhs. So what they are asking, compute the adjustment to be made to the total income of XC Limited, assuming that such adjustments are made by the AO, and state whether it can claim deduction under section 10AA for the income enhanced by applying transfer pricing provision. They are saying, okay, you will apply the transfer pricing provision and then you will increase my income, but because the entity is located in section eligible for section 10AA exemption for sales unit, okay, can they get the deduction for increase in income? Obviously no. Then what's the point in making TP adjustment, isn't it? We have already discussed this in a proviso provided in section 92 that whenever increase happens, we will not provide you any chapter 6A deduction, neither 10AA deduction, and the corresponding party will also not get any deduction or any modification in their computation of total income. That is the consequence of having transfer pricing adjustment. XC Limited, Indian company, and Zilla Inc., US based company, are deemed to be associate enterprises as per section 92A, since Zilla Inc. hold shares not less than 26% of the voting power. Okay. As per explanation to section 92B, the transaction entered into between these two companies for sale of the product, lending and guarantee and provision of the service relating to market research included in the international transaction. So all these transactions are international transaction. Two conditions are complied. Third condition should be the transaction should have happened at arm's length price. Accordingly, transfer pricing provision would attract, and the income arising from such transaction have to be computed having regard to arm's length price. These three paragraph or three pages are almost fixed. Whenever you drop the answer, paragraph 1 AE, para 2 international transaction, para 3 ALP. These three paragraphs you have to write, make a practice of these three paragraphs. In this case, from the information given, the arm's length price has to be determined taking the comparable uncontrolled price method, because that is the most appropriate method according to the data. So this is the method. Section 92C, which method you have to follow. As I told you, cup method will be the one of the most common method. So here also it is cup method. Amount by which total income of XC Limited is enhanced on account of the adjustment in value of the transaction is difference between price of the t-shirt. So 1 USD for each t-shirt for 1 lakh pieces. Convert it into Indian rupee. So rupees in lakh is 64 lakh. Difference for excess payment of the guarantee for loan, please understand. So $3,000 into 64 in rupees it is 1.92 lakh. Difference payment for services market service services. So 5,000 extra USD into 64, 3.2 lakhs. So these are the simple adjustment that we have already discussed. So total addition that will happen to their existing income is 69.12 lakh. Sir, will this 69.12 lakh be eligible for 10AA deduction? Definitely no. XC Limited cannot claim deduction under section 10AA in respect of 69.12 lakhs being an amount of income by which total income is enhanced by virtue of first proviso of section 92C subsection 4. Thank you.